Good morning. Welcome to YX Insights. This is Yimin. Today is Friday, December the 12th. We are pre-market open. I'm going to first share a few thoughts about the FOMC, the liquidity conditions, and then we are going to cover chart analysis in equity indices, bonds, crypto, commodities, and the Max 7 stocks. So the overall market regime right now is risk on. So I have built a machine learning model for SP500, the SPY ETF. And you can see here as an indicator, risk on gets a score of 1, meaning the model likes to be long or buy the asset, and risk off with a score of 0 means the model likes to sell or stay on the sidelines. The model went risk on very early at the beginning of May when the market just started recovering from the March-April sell-off, and it has stayed risk on all the way until early November. We had a market decline in October to beginning of November, in which the market sentiment became very fearful. But since liquidity improved after the government shutdown, we actually saw a sizable bounce now in the market, now at the all-time high. And appropriately, the model has gone back to risk on as well to capture this gain. And what I thought about Wednesday's FOMC is that while the Fed has raised the bar for the next rate cuts, the overall stance is still very dovish. So firstly, the Fed didn't actually have to cut rates this week, but they did, even with 2 voting members dissenting from that decision and preferring a no change. And if you looked at the dot plot, 6 FOMC members, including the non-voting members, preferred no change in this meeting. So despite a diverging view within the Fed, the majority still voted for a rate cut. So you can still see that the Fed is on the margin dovish, even though they haven't had that much employment data or CPI data since the last time round. And the September non-farm payrolls data was actually pretty robust. And then secondly, the Fed is buying $40 billion of treasuries, treasury short-end bills every month from this month onwards to help the liquidity in the interbank lending market. So let me show you this chart. SOFR, the secured overnight lending rate, versus EFFR, which is the rate that is set by the Fed. The spread widened substantially in the October month end as well as November month end. So 25 basis or more means that the banks are so short of liquidity, they need to borrow cash so desperately they're willing to pay a full rate hike above what the Fed has set as interest rates. And those spikes has the Fed very concerned, because not just thinking about this month end, going into next year, the quarter end April tax receipt season, this liquidity issue could probably get much worse if the Fed doesn't do anything. And therefore, they are starting this 40 billion treasury bill purchase program from this month to ease this liquidity issue in the interbank lending market. So it's not a big number. 40 billion is nowhere near the size of the QT that the Fed did previously, or the QE back in 2020, 2021. But on the margin, it will help calm the liquidity situation and be supportive of risk asset sentiments. So the Fed doesn't really want to see financial market disasters because of the liquidity conditions being too tight. But as the Fed funds rates now sit on the upper end of the neutral rate estimates, which is 0.5 to 1% above the inflation rate, the Fed can now afford to wait a bit longer, observe more data before making the next rate cut decision. In the near term, we should see risk assets continue moving up, especially equity indices, I also think Bitcoin will also benefit from it, and a number of Max 7s as well. If you looked at the Treasury General Account balance, that has declined very nicely since the beginning of last week. There has been a $100 billion of liquidity moving from the TGA balance at the Fed into bank reserves just in the past couple of weeks. So that coincides with the broader market recovering to the all-time high again. So now looking at SPY's technicals using our Elliott wave theory analysis, I see SPY moving higher into early next year, and we are potentially completing the wave 1 of this initial rally first. So I wouldn't want to preempt the exact timing of this wave 2 decline, but if it does happen, I do think 660 to 670 is a strong supportive region. A lot of buyers are looking for the dips to get in here. I don't really see a lower low that would breach this 650 level in the near term. So, of course, the market has been in a more cautiously consolidating mode as we approach this all-time high. But if we get a pullback, I do think that is a dip buying setup opportunity for a much higher high in wave 3 that gets into the low 700 level. And generally, how banks' research desks would put their year-end target for next year is looking at the earnings growth, which could be anywhere between 10 to 15%, and the valuation multiple, the PE ratio, which is now at a very elevated level. So they probably won't revise that much higher, whereas they are probably just going to put a 10% bump to where we are today. That would bring us to somewhere in the 750 to 770 level. And that does coincide with our technical analysis as well. Looking at Q, so QQQ didn't quite reach the all-time high like SPY did. But if we do get a retrace from here, we are looking at, I think, 600, 605 as a very strong supportive region. I do think a lot of buyers will try to come in and catch the final wave into the year end and beginning of next year. Most of the institutional investors are behind their benchmarks this year because they got in the market too late after the April sell-off. So they could get much more aggressive in the long positions going to the year end. For IWM, I do think we will see higher highs. It's already broken the all-time high, this previous all-time high this week. So in a way, it's leading SPY and the QQQ. I do think 270 is a very realistic target into next year for this wave 5 completion. The 30-year yield, my view has changed a bit this week after it moved above the 200-day moving average and now breaking above this resistance zone. So the overall chart level now looks more like an inverse head and shoulder pattern where we can get much higher. And this looks like initial leading diagonal down, 5 waves. And now we could get an ABC corrective rally upwards. But this won't be the main trend. So I don't think we'll get a new high beyond 5.15%, for example. I think we'll get a lot of resistance around the 5% mark to complete this wave C before going lower. So this rise in yields has mainly been driven by high inflation expectations. If you look at true inflation measures, that has been going up because goods inflation has gone up. And it's driven by some budget deficit concerns because big spending could mean the US will have to issue much more longer end bonds in the next couple of years. That threatens the credibility of the treasuries, as well as the price levels. In the near term, the investors could be refocusing on those two factors and we can get another spike into 4.9 to 5% region. So TLT, a near mirror image of the 30-year yield, we have the 5 waves initially completing here, and it had showed us a pattern where we have the A, B, C wave, and wave C could complete below 87, potentially reversing around the 200-day moving average. And the deeper end of this target would be around 86, where volume starts to pick up for support. So I don't think this breaks the overall uptrend, but this is the first correction we'll get for the longer term. USO, so we cover USO in our commodities signals channel. It has been risk off since we started our coverage, and it has mainly been very bearish leaning. It couldn't quite get above the moving averages as well as this resistance zone. And now we are testing a new local low, potentially starting this, the rest of this wave 5 down towards 60. There is fundamentally a lot more supply coming into the market, both from OPEC countries and North American producers in the US and Canada, which will likely put pressure oil prices further. Looking at Bitcoin, it has consolidated sideways for most of the past couple of weeks. So we had a nice breakout retest, but we haven't really had that momentum towards the wave 3 target. On the margin, I do think consolidation sideways is probably not bad news given how bearish the sentiment was over here. And this could have been a 1-2 setup with wave 3 testing the 100K mark. And that 100K would be a very big psychological resistance zone, especially with the volume profile over here. So we could get a retrace after we reach 100K. But for now, there's no reason for me to think that wave 3 is not valid at the moment. So my primary expectation is still for Bitcoin to move upwards into the year end and beginning of next year. Similarly, for Ether, I do think this could have been a waves 1-2 setup, and now we are moving towards wave 3. Interestingly, ETH has been on a relative strength basis stronger than Bitcoin, and this wave 3 could really test the 200-day moving average before a shallow retrace in wave 4. So this impulse wave is my most ideal scenario for ETH. Once we get to this volume heavy range and we can start thinking about the next pullback back towards 3,000, that would really set us well for a 1-2 setup on the larger degree for the next big cycle. Solana hasn't really come out of its downward trend yet, hasn't managed to break out of this line, but given the clues in the other market and we are seeing consolidation in this price region, I do think on the margin, I would start leaning bullish in the near term. So just to clarify, all of our signals are still risk off at the moment for Bitcoin, ETH, and Solana. So it's not, we are still quite early in this recovery phase. Ideally, I really want to see Solana breaking out of here and moving above the 50-day moving average to really kick off the beginning of our recovery process. So XRP, we have just started covering this in our machine learning signal. And I want to just cover the broader picture first. To me, this looks like a 1-2 setup over here with a strong rally into wave 3 in Q4 last year. And since then, we've had a sell-off, a rally, and another sell-off. That looks like a flat structure in earlier waves. So this is not an impulse wave 5, but rather this is a running flat in wave 4. So I do think we still get a new high in wave 5 that could potentially target 5,000 plus. Looking at Coinbase, so you will start seeing that the crypto charts all look very similar given the high correlations, but the magnitudes and speed don't look exactly the same. So Coinbase could be moving in this wave 3 initial rally to build a recovery, but is struggling under the 200-day moving average. So we just need a bit more patience to see a breakout above this level and ideally above 320 to confirm this wave 3. Robinhood. Robinhood isn't an easy chart to decipher. So currently I lean towards this being an ending diagonal with every single subwave having 3 waves. So ABC up for the first wave and ABC down for the second wave, and now we're in wave 3 that could also be in ABC shape. And within this wave A, we are getting an ABC pattern as well. So I think that is actually the most bullish interpretation we can have. And of course, there's always this possibility that this is the top, and from here onwards, we're just looking at a much lower low here. But given the broader market and how Robinhood has led the market moves for the best part of past year, I do think we should get a one more high that exceeds the October high. So if we get below this 200-day moving average, my bullish thesis could be invalidated, and we need to then start thinking about how far Robinhood could start correcting. Strategy, we have an ABC move down where we've seen more or less tapped the 123% extension of this wave A from the wave B high. So this typically is the wave C target zone. I wouldn't expect a much lower low than what we had at the beginning of December. From here, ideally, I want to see a 5-wave up move with the Bitcoin recovery. And of course, it's still very early in this phase, and we are looking for a strategy to at least capture the 50-day moving average. Looking at BMNR, BMNR trades at 1.2x MNAV, so 20% above the net asset value. And investors really do love this stock a bit more than SharpLink, maybe because of Tom Lee's personality. Bitcoin is one of the most hotly traded stocks in the entire market, not just in crypto. And it has rallied with stronger moves than SharpLink in this recovery. So the real challenge here is to move past the 50-day moving average and hit our initial wave 3 target at 47 or more, even 50, where there is significant volume here as resistance. And then we can see a retest and then one more wave higher to complete this initial recovery process. But already we are not quite double, but nearly double from this low here. And one thing I like to look at is the BMNR versus ETH ratio. So it shows how much is moving relative to ETH. And you can see that BMNR's velocity of recovery is much faster than ETH since 2 weeks ago. SBET. So the leadership of SBET consists of 2 well-known founders. They're both called Joseph, but one of the Josephs is the original co-founder of Ether, and the other one is head of ETF strategy at BlackRock, so helping the ETH spot ETF for ETH last year. And the 2 of them, I do think, as a combination, work very well because one has the technical expertise and actual network in the broader crypto system. He understands deeply about how ETH would evolve, Ethereum would evolve, whereas the other, Joseph, has deep knowledge and wide network in the capital market. So the combination of the 2 is tremendous. Looking at the latest recovery, I want to see SBET moving towards the 13 mark, potentially first hitting this resistance at the 200-day moving average with a shallow retrace in wave 4, and then one more high into this volume profile here. So that could complete our initial wave 1 rally for the next cycle. We get a retrace for the wave 2 setup, and that would look like a double bottom, and we can think about the wave 3 on the large degree after that. Looking at gold, I have been bullish on gold for a while since this bottom, and I think we are now in wave 3 that could target the 400 plus region. And I do think this is likely the wave 5 of a high degree wave 5. So the end of this bull cycle for gold. But this could be much, much higher than where I have projected. I'm just projecting the standard estimates using Fibonacci levels at the very early stage, but we could get really parabolic into next year. Typically, gold doesn't end its cycle until the stocks market has, so there could still be some time before we see the ultimate top. Looking at gold miners, GDX, I also think we are in wave 3, and actually GDX has outperformed gold itself. So we could potentially be getting a retrace of this wave 4 pullback next before completing the next wave 5. Overall, I don't see a reason why this cycle doesn't close above 100. Silver has been very strong in the past couple of months. Since our commodities signals have launched a month ago, it's already up 22%. So now we're looking at potentially hitting the top end of our wave 3 target, which could push to 60. And I would be expecting a wave 4 retrace at some point before the next wave higher. So I do think 58 to 60 is potentially a resistance band for this rally, and I will just watch from there. Silver miners, very similar to silver in price action. I do think 85 to 88 begin to look like a resistance level from a wave 3 extension point of view. I'll be getting a little bit more cautious, getting further deep into this territory, and we could get a wave 4 subsequently before the final wave 5 or 5. PALL, just zooming out a little bit, I think this was a wave 1 and wave 2 setup at the end of last year, and we've completed all 5 waves of this wave 3, and now we're in the wave 4 retrace zone. So wave 4 could have well finished over here. That would be a standard pullback between the 23% to 38% retrace of this wave 3. There's also a chance that we are getting a wave B rally first, and then a flat structure for a retest of this low in the wave 4. So this wave 4 may not have ended. But the larger degree, I do think we will eventually get a higher high in wave 5. That could be in the 180 region. PPLT. So I do think this was a 1-2-1-2 setup. We've had a very steep rally in this wave 3, completing all 5 waves. And potentially now we could have completed wave 4, but there is a chance that this is a flat structure where we tap the all-time high and then we head down to retest the lows again to finish this wave 4. So both options are valid, but I am getting just a little bit cautious as we reach this high, and I want to see how it resolves on the downside before mapping out the wave 5 on the larger degree. Copper, I think this was a 1-2 at the beginning of 2023, and since then we are in a steady upward channel within the larger degree wave 3. So from an extension point of view, this rally from the wave 2 low in 2023 to July 2025 is sufficient for completing the wave 3, but I don't like it because this pullback was pretty steep, and normally you wouldn't really see this type of wave 4. So if this was a wave 4, that is quite close to wave 1. You don't really see that in the subwaves of a wave 3. It could, of course, be valid, but I would prefer one more high in this wave 3 structurally getting to the 40 level. That will be the 1.7 extension of this wave 1, and then a wave 4 completing at the bottom of this channel here around low 30s level before wave 5. That would look proportionally appropriate also for this wave, larger degree wave 3. One other factor I have been looking at in my expectation for higher copper prices is, if you look at the copper versus gold ratio, of course, gold has rallied a lot recently, but it does have it does coincide with the business cycle where when the business cycle peaks, we have very high copper versus gold ratio and vice versa. And if you look at the bottom here, that actually coincides pretty well with the Bitcoin peaks as well. And so December 13 was also where Bitcoin peaked. And again, copper versus gold ratio peaked in December 2017. And that's basically where we peaked in the 2017 cycle as well. And then again in October 2021, Bitcoin topped in November 2021. And since then, we haven't had another peak. So I do think we are only halfway through the business cycle yet. We should get one more peak in this copper gold ratio, and that should correspond with the real Bitcoin top next. So given this ratio hasn't peaked, I don't really think Bitcoin has also peaked. But coincidentally, it has been 4 years. And one of the theory is that a 4-year cycle really corresponds with the debt maturity cycle, and the debt maturity in the US has expanded from 4 years to 5 years. So we still have some time left in the broader rally into 2026. Looking at Apple, I think this wave 4 is sufficiently complete around 270. I think we could potentially start looking at wave 5 into beginning of next year, potentially into the earnings. That should target the 300 level for Apple. Amazon, we've had a retrace that could be a wave 2 retrace. And I do think we should get a new all-time high into beginning of next year. So we could start attempting wave 3 first around the 280 level. And I don't think we are done in this uptrend yet. So the volume here to me actually suggests accumulation in this 200 range, which coincided with the top of 2024. So there's a lot of buying interest here. We're just consolidating sideways since the summer, but that bodes well for the next wave higher into the 300 area overall. Google, for me, I wouldn't say Google is expensive relative to growth. It has a PEG ratio of 0.9, so PE adjusted by its growth. But the valuation multiple has expanded significantly since the beginning of this year, so by 50%. And it is now valued at the 2 standard deviation above its 3-year average. So moving from the 2 standard deviation below the mean to 2 standard deviation above the mean is a big run. I am not surprised to see a retrace pullback to digest that gain and consolidate before we have one more high above 400. Meta, there is a case to be made that this is an ABC correction down, but I am a bit more cautious in my downside interpretation. It has turned down from this 200-day moving average. And now the real test is whether we get a new low or not. If we can hold this low just below 600, we could be looking at a wave 1-2 setup, so invalidating my current structure. But if we breach this low, we're looking at much lower, potentially in the low 500 level. So this low will be critical in the coming weeks. Microsoft, I do think the November sell-off was a wave 4, wave C of this wave 4, which was quite aggressive. Now we're thinking of the initial rebound. I do think we should at least challenge the 50-day moving average before completing the wave 1. And wave 5 should have one more high above 600 going to next year. NVIDIA's price technicals haven't been great. It couldn't get above the 50-day moving average. It's now holding on to this large volume profile here. And potentially this crab in the wave 5 top. So I'm inclined to wait for NVIDIA to really reveal itself before calling this the head and shoulder pattern. Ideally, I want to see how the price bounces next. I'll have a target of 200 for this potential wave B rally. And I want to see how NVIDIA reacts at this $200 mark. And if we turn down from here, then that would confirm this is a wave A, larger degree wave A, and wave B bounce. And then we can see a wave C lower, potentially testing the 200-day moving average next. Tesla has been quite boring in the past couple of months. It's just been moving sideways. We did get a slightly steep pullback in this wave C when people started calling for much lower lows, which of course didn't happen. But now we are above the 50-day moving average. It's still sort of consolidating sideways, building volume in this region. I don't mind seeing a pullback here towards 410. If we get a pullback, that could set us well for wave 1A setup towards 500 plus for wave 3. There will be a lot of people trying to take profit just under 500 because that coincides with the 485 high watermark from December. We still haven't quite got to that level yet. And so if we get to 500-ish, we should see another big resistance. But ultimately, I do think we should end around mid 500 in this wave 5 rally. And I think it should happen by February next year. PLTR, my concern is that we topped in November and we could be looking at wave B here. So this bounce has found its way above the 50-day and now slightly above the volume profile. So where it goes from here is key. If we can get above 200, I think we could invalidate this bearish expectation, and we're looking at potentially one more high and how that would manifest. But if we turn down from under 200, we are looking at retesting the 200-day moving average finally in this correction. So what it does by end of December will be very telling for how it evolves in 2026. SOXX, the semiconductor ETF, I do think we should get one more high here. It's already broken above the all-time high, which is great. And my target for wave 5 is 330. I don't really have that much more to say about SOXX technicals. It's just been very bullish, and it has been on a relative strength terms much stronger than NVIDIA. So that says a lot about the money rotation and the wider demand for the semiconductor play. Still very well live, even though everyone's talking about bubbles. So that's it for this week. Thank you very much, and I'll see you next week.